So when you're looking at the potential next steps for the portfolios and talking with the different money managers, the institutional money managers, this is what we're seeing out there. And again, I want to thank City National Rockdale because on the left-hand chart, you've got asset allocation positioning, you got stocks and bonds. So under the asset allocation positioning, you've got the current, which is where we are today, a base case, which is right now looking more neutral, best case scenario, worst case. And how does that apply to where you want to be within the stocks and the bonds? Let's go to base case first. You know, when you have signs of bottoming in the economic activity, that is a good sign right there. But it's the beginning of a new growth cycle. And when you're talking about a beginning of a new growth cycle, what do you need to do? Well, in this case, you want to add cyclical US equity exposure because that's a strong case at that point. Then you want to reduce the investment grade fixed income. Why is that? Well, because as everything starts shifting more to US equities, where does it come from? It comes from fixed income. So that would be the base case there where you have a neutral weight on both sides. If you look at the best case, now let's look at it from a higher confidence of a multi-year expansion and the geopolitical risk is easing. In other words, if the war ended, how do you decide to invest from a global standpoint? Well, when you're looking at this in a best case, the US tends to be a very strong market and tends to pull out sooner. So we'd be overweighting US equity exposure and underweight fixed income at that point. And from an international equity, again, if everything is settled down, well, I think it's a good time to get into international equity under those circumstances. But if tensions go higher, then, well, we might want to be very selective as to where we go from an international equity standpoint. Now, let's look at the worst case. High risk of structural bear market, deeper recession, and, man, some major shocks that could hit the system. In that scenario, where would we be? Well, we would reduce the equity exposure, just like we have over time here. And we'd increase the allocation in the investment grade fixed income, again, like we have done so far. So it's interesting. It kind of lays out the asset allocation positioning that the money managers are looking at as they work to manage that portfolio, to minimize the downside and really maximize the growth when the markets turn around. So there we are.
You know, it's interesting when we look back to when we were doing these webinars last year, we talked about going from equities to cash because you couldn't go to bonds because they were going down like the equities. This year's scenario is a little different.
Yeah.
Now that we've got some yield out there to work with in the fixed income market, it makes sense not to go to cash,
Absolutely.
but to go into the bonds and hold those as your stabilizer.
Yeah, and as
until the economy turns
right,
around.
and as most of you know, we're working with really shorter term, shorter duration treasuries in a ladder type portfolio, or Fidelity has got a pretty good rate on their money market for anybody who has $100,000 or more. So you're looking at 4.5+% for there. So it's easy to get in, easy to get back out again when we need to.
Right.
So yeah, we've got the solutions, and at the end of the day, you know, we're ready for what you need to do, right? To get ourselves in play and make sure that you're taken care of. There's really no need to worry. You take care of your family and
we'll take care of you. We're ready for the future.